Hi and welcome to Academic Compliance Academy of Anti-Money Laundering. So in this video, I'm going to talk about the problem of de-risking and money laundering. What is de-risking? Well, I have two definitions here on de-risking. The first one is the World Bank. So they define de-risking as the situation where global financial institutions are increasingly terminating or restricting business relationship with smaller remittance companies and smaller local banks in certain regions of the world. So this definition really tried to grasp the globalized financial industry, saying, okay, so what we see is that some banks tend to terminate their relationships with smaller banks in certain regions of the world where it can be hard to surveil, or they don't want to mitigate the inherent risk of that relationship. Another definition is by the Financial Action Task Force from 2014. So they define it as de-risking refers to the phenomenon of financial institutions terminating or restricting business relationships with clients or categories of clients to avoid rather than manage, hence mitigate, risk in line with the risk-based approach. So here we can see that it's more focused on the clientele and not just business relationships. So why has this de-risking become a problem at all? Well, we can see that the problem arises all over the world, because typically when we have a risk, we tend to, in a very standardized model, we tend to have like four options. We can accept the risk, reduce the risk, transfer, or avoid. When we talk about de-risking, it is pure avoidance, because we don't want to mitigate the risk that some operation exposed to our business operations. Thereby, we terminate the relationship and avoid the actual risk. This tend to hit smaller cash intensive businesses like the local pub, because cash in terms of money laundering has a high risk profile because we cannot trace it. So in that sense, a bank might choose to limit this type of clients because it's hard to mitigate the actual money laundering risk. We've also seen it in terms of NGOs. That's why I put up like a number of names of different NGOs here. So NGOs operate across the world and in regions that might be outside of our legitimate sector, which also means that they tend to operate in jurisdictions where there might be a high corruption index or other risk factors, thereby having a high inherent risk. And that is why that we've seen that some of them actually suffers, because banks tend to be de-risking. They want to avoid the risk and terminate the relationship with the NGO so they don't have them as clients. I also put a picture up here of an elderly couple, because some of the clients can also be just people who usually tend to use cash as their means of purchase. And we have seen that not only is just the risk of cash a driver of this de-risking, but it might also be, as with the elderly couple, that, well, they're not that profitable. So let's look more into the key drivers of what really enforces this de-risking. I already been talking about some of them. So first one is perception of risk. So this is from Oxfam 2015. The first driver, perception of risk. Is risk always bad, and how should we accommodate, how should we mitigate risk? Well, if you always consider risk for being a bad thing, like a credit risk, so we have a history of having that perception, well, you kind of need to understand that if that is your perception, of course you tend to de-risk because you want to get rid of any bad exposure of your business operations. Second one is client profitability, as with the elderly couple, that you don't see a large company that might be cash intensive, where they have a lot of cash operations. You rarely see that they actually get their business relationship with a bank terminated because they are profitable. And that links with the next couple of drivers of de-risking, which is increased compliance costs. So the regulation has increased, hence also the cost for complying with the regulation, and also the risk of sanctions. So when the cost is on the increase, and if you have a client with a very, very low profitability, well, the business solution here would also be de-risking. Just get rid of them because it costs too much in the books, contrary what we actually gain. The last one is reputational risk, and we've seen that especially within money laundering about all the banks that might have operation in some jurisdictions that may not be any money laundering happening, but the risk is simply too high, so you tend to get away. So these are kind of the five main drivers going towards de-risking and explaining why does it happen. And the problem is that it typically hurts a lot of people that should not be hurt. But there's also another problem, and that is what is relevant now, the problem of money laundering. So when we talk about money laundering and de-risking, is there any problem here? Shouldn't we be glad to avoid the risk of money laundering? That depends. If a large bank has a client with a high risk profile in terms of money laundering risk, and they de-risk these clients because they want to avoid the actual money laundering risk instead of mitigating the risk, well, that client needs to have some kind of way into the financial system. And here I illustrated it by he's walking over to a minor bank that might not have the same control system and surveillance mechanisms in place, and they say like, welcome, come to our bank, because we cannot see the same risk picture as your former bank. So this is one of the risks, that we might not get rid of the actual money laundering risk, we're just transferring it to another bank who cannot surveil in the same degree. This is one problem. Another problem is if we take the big picture, I put up the world here, and this is maybe where we should tend to focus a bit more on the definition by the World Bank. So let's imagine that we have an effectively surveilled economy. Large banks having really good compliance operations, they can surveil, they monitor everything, they mitigate the risk. Then we have an ineffective, maybe small banks that does not have the same capabilities. We have the shadow economy, the non-regulated economy, and then we have the underground economy. When larger banks tend to de-risk in terms of money laundering risk, they remove their clients, and there are only two places to go because they still need access to some financial products. So they will either go to an ineffective surveilled economy represented by maybe smaller banks, or the shadow economy outside of the regulated field. So do we want this in terms of money laundering risk? No, we do not want this. And that is the problem. The problem of de-risking when it comes to money laundering is that when we de-risk, we're not mitigating the money laundering risk. We're actually not trying to solve the problem. We're removing the problem simply because we don't want sanctions. We don't want to be a part of money laundering. But we have to remember that money laundering is a societal problem. And to solve that, we need a whole another level to reach compliance. But that is another video. So can we say that de-risking equals money laundering? No, but we can say that when banks tend to de-risk, they are kind of taking the easy way out because they're not mitigating the risk. There's nothing wrong with having a high risk client in terms of money laundering if you can mitigate the high risk. So when you de-risk, what you actually do is you kind of, because they can either go to a less like an ineffective economy or the shadow economy. When we de-risk in terms of money laundering risk, what we do is kind of we're putting some shades so we get less surveillance of the actual money laundering risk, which makes it so much harder to try to combat money laundering. So de-risking does not equal money laundering per se, but it makes it much harder to combat. So that was it for this video about the problem of de-risking and money laundering. Stay tuned, subscribe to the channel, and let's talk much more about money laundering.